Short selling.
Mm-hmm.
We are diving deep into the risky, yet potentially highly profitable world of betting against a stock.
That's right. And this isn't about passively buying stock and, hoping for the best.
No.
We are examining an entirely different discipline.
Yeah.
Short selling is inherently risky because of the foundational math, really.
Right.
Your maximum potential gain is capped at 100%. The stock goes to zero.
Which is rare enough.
Exactly. But your losses, they're theoretically unlimited if that stock just keeps climbing indefinitely.
That asymmetry alone makes it sound, well, like a fool's game. Why would anyone actually volunteer for that kind of stress?
Well, because when executed with truly rigorous research, short selling plays a vital non-speculative role. Successful short sellers often act as the canary in the coal mine, identifying endemic or systemic problems, whether they are hidden fraud, reckless leverage, or maybe irreversible market shifts, long before the broader market or, frankly, the regulators catch on.
And this framework, this way of thinking, it's essential, even if you never intend to short a stock in your life, right?
Absolutely. Understanding why a business fails, the structural flaws short sellers actively hunt for, is arguably the single best defense for long investors. It allows you to analyze weaknesses in your own portfolios and, avoid those dreaded value traps.
Yeah, nobody wants those.
Exactly. So we are moving beyond simple market rumors about, oh, that stock's overpriced. We are going to use the definitive methodology employed by those who made fortunes, exposing major flaws. Think Jim Chanos on Enron.
The classic.
John Paulson in the subprime crisis, and those dramatic implosions of high-flying growth darlings.
Yeah.
We will show you the exact framework they used.
Okay, let's start with the groundwork then. The due diligence, the discipline that's really demands. Okay, let's unpack this. Starting with the fundamental paradox of shorting. Warren Buffett summarized it beautifully, didn't he?
He did. He noted that it's incredibly common for promoters and market excitement to cause a stock to become valued at 5, even 10 times its true value.
Happens all the time.
But it's incredibly rare, almost unheard of, to find a stock trading at just 10 or 20% of its true value.
That statement just perfectly encapsulates the difficulty, doesn't it?
It really does.
Rare.
The market has this inherent bias towards optimism, innovation, growth. It's built in.
Right. Hope springs eternal.
Exactly. When things look good, investors are willing to pay a premium based purely on hope. So things can remain irrationally expensive for a long, long, painful time if you're short. But the reverse isn't true. If something truly looks like a bargain on the long side, other investors usually spot it pretty quickly, they bid up the price, and poof, that valuation gap closes.
So on the short side, you're constantly fighting market gravity, fighting that overwhelming optimism.
Constantly. That's why you need more than just, it's expensive. You need a verifiable structural flaw, something concrete.
Okay, so let's look at the poster child for accounting fraud. Enron. How did Jim Chanos find the fundamental opening back in, 2001?
Well, Chanos became an early and aggressive short seller of Enron. He started noticing red flags tied not just to its high valuation, which was there, but more importantly, to its financial disclosures.
Okay.
Particularly something called gain-on-sale accounting practices, especially related to its asset-light businesses. This was the critical flaw he really zeroed in on.
Gain on sale. That sounds pretty technical for the listener. How exactly did that allow them to basically manufacture profits?
Yeah, think of it this way. When Enron sold an asset, say a power plant or maybe a future energy contract, they didn't just book the actual cash profit they received right then.
Okay.
They were allowed, under the accounting rules at the time, to book the entire estimated future profit of that asset sale immediately, up front.
Wait, the estimated future profit?
Yeah. So, for instance, if they sold a power plant for $100 million and they estimated that the buyer would make another $50 million over the next decade from it,
Right.
Enron would book the full $150 million as current income right on the day the sale closed.
So they were essentially just creating earnings out of thin air based on their own internal, probably very optimistic projections.
Precisely. That's exactly what Chanos highlighted in his congressional testimony later. He said this practice allowed management to consistently create earnings out of thin air.
Wow.
Which gave the illusion of continuous, robust profitability and, of course, justified an ever-increasing stock price. His research dug up these really ominous accounting signs, coupled with Enron's rich valuation.
And what about the Wall Street analysts? Weren't they seeing this?
Well, that's the other part. When he spoke with them, he found their buy ratings were often marred by clear conflicts of interest.
Ah, the banking relationship.
Exactly. They were primarily interested in securing Enron's lucrative investment banking business, not really uncovering the truth. So for Chenos, the valuation was just a secondary indicator. The real thesis was the accounting manipulation.
Got it. Now, let's pivot to a different but equally massive systemic issue, the subprime crisis. John Paulson's famous trade. This wasn't about manufactured earnings, was it?
No, completely different. This was about mispriced risk and excessive debt. It required a completely different type of forensic research.
So what did Paulson do?
Paulson conducted incredibly detailed independent research in 2005 and 2006. He dug deep into the housing market and, crucially, the structured products built upon it, those mortgage-backed securities.
Right, CDOs and the like.
Exactly. And his conclusion was conceptually simple, but totally revolutionary at the time. He basically said these highly leveraged AAA-rated mortgage securities, which everyone thought were the safest assets on the planet.
Safer than treasuries, some said.
Right. He concluded they were fundamentally mispriced and were very likely to become worthless.
The market believed these were rock solid, yet Paulson saw the underlying collateral, subprime mortgages, often made with zero down payment, was paper thin. But why bet against the banks? They weren't the ones taking out the mortgages.
That's the key insight. The fatal flaw wasn't just that the collateral would fail, though that was part of it. It was the excessive, often hidden leverage used by the financial firms exposed to this collateral.
Ah, okay.
This is where the numbers just get terrifying.
Give us the context then. How leveraged are we talking?
Well, consider Lehman Brothers. Just before the collapse, they operated with more than 40 times the assets compared to their tangible common equity.
40 times.
40 times. And tangible common equity, that's essentially the real cushion, the real money the shareholders have put in that can absorb losses.
And what's normal for a bank?
A safe ratio for a traditional bank might be, 10x, maybe 15x leverage on that basis. Operating at 40 times meant Lehman was trying to carry 40 times their own body weight, metaphorically speaking.
Wow. So like you said, a stiff breeze could knock them over.
It absolutely could, and it did. Their equity cushion was just too thin, far too leveraged, to absorb even a moderate amount of losses when that underlying subprime collateral started failing.
So Paulson wasn't just shorting housing.
Not at all. His short was against the financial system's structural reliance on mispriced collateral and, frankly, dangerous levels of leverage. When Paulson bet against those subprime bonds using credit default swaps, the CDS market, he was really exposing the entire system's vulnerability. It was a systemic bet.
So the key takeaway from these legends, from Chenos and Paulson, it's clear. Successful shorts are not based on simple speculation or just guessing something's too high.
Absolutely not. They are built on uncovering deep fundamental problems. Accounting risk in Enron's case, and leverage and mispriced asset risk in Paulson's case. Without a structural flaw that you can trace to verifiable data, you're essentially just hoping the market eventually agrees with your definition of expensive.
And hope, as they say, is not an investment strategy.
Definitely not in the short selling game.
Okay, that leads perfectly into our next point, which you just touched on. You cannot short a stock based purely on the fact that it looks expensive. High valuation is a dangerous, often fatal trap for short sellers.
Yeah, it really is. Valuation can be a confirmation, right? It might suggest the potential payoff is higher if you write about the flaw.
Sure.
But it is never the thesis itself. Selling short based only on high multiples, whether it's price to earnings, PE, or price to sales, PS usually fails. Why? Because market irrationality can be incredibly persistent.
Right.
If your only thesis is, it's just too expensive, you will likely get squeezed out. You'll be forced to cover your position when the stock keeps rising, regardless of your conviction on its fair value. The market doesn't care about your fair value calculation in the short term.
Help our listener understand what a high PE multiple truly signifies in this context. If a growth stock trades at, say, 30 times current earnings, what promise is the market really banking on?
It indicates extremely high market expectations for future earnings growth, often for many, many years to come. Let's use the simplified example from our source material. Imagine firm A is priced at $30, giving it a PE of 30x. Firm B is priced at $10, PE 10x. The market is clearly expecting firm A to grow earnings exponentially faster.
Makes sense.
Now here's the crucial part for short sellers. Let's say firm A actually succeeds. It grows its earnings from $1 per share to $3 per share over, say, 2 years. Great performance.
Right.
But maybe then the market decides, okay, the hypergrowth story is over. Now it's just a normal company. And it assigns it a PE multiple of only 10x, the same as boring firm B.
Okay, so the multiple collapses from 30x to 10x.
Right. But what happens to the stock price? It's $3 in earnings times a 10x multiple.
Mm-hmm.
It still stays at $30.
Ah. So the stock price doesn't collapse simply because the multiple compresses?
Exactly.
The underlying earnings growth has to actually fail to materialize in the first place, or disappoint massively.
Precisely. The high starting price means the market has already factored in significant future growth, unless you can find a structural flaw or a clear catalyst that prevents that expected growth from happening. Your short position is just sitting there, bleeding cash from borrowing costs, waiting for a valuation correction that might never come or might come only after the earnings have caught up.
And nothing illustrates the sheer danger of shorting based on valuation alone better than the story of Cisco during the late 90s tech boom. This is the ultimate warning shot, isn't it?
Oh, the Cisco story is absolutely brutal for shorts. So back in July 1999, Cisco was trading at roughly 20 times sales. Its PE was about 90.
Insane numbers even then.
By every historical metric, it was astronomically expensive. A concentrated short bet seemed completely rational based only on those valuation metrics. Like, this can't possibly last.
But what happened next just demonstrates the market's capacity for true mania.
It does. Despite that seemingly unsustainable valuation, Cisco reported unexpected, aggressive growth. Just blew away expectations.
How much growth?
Over the next year, driven by the massive build-out of internet infrastructure, everyone needed routers. Cisco reported a whopping 60% increase in sales. 60%.
Wow, on an already huge base.
Exactly. Yeah. And this unexpected growth pushed the stock even higher. It ended up trading close to 25 times sales, and its PE ratio ballooned to approximately 200.
Wait, so the valuation actually got more expensive, even though it was already considered completely irrational?
Precisely. It went from nosebleed to stratospheric. A short bet initiated at that supposedly extended 1999 valuation of 20x sales would have resulted in a staggering negative 110% return over the next year or so. You wouldn't just lose your money, you'd owe more. You would have been completely wiped out.
Oh my God.
The thesis that Cisco is overvalued was, in the long run, technically correct. It eventually crashed. But the trade failed spectacularly.
That must be psychologically just devastating. You're watching your conviction lose you more and more money every single day just because the market is willing to pay an insane multiple.
It is. And the core lesson, citing the famous John Maynard Keynes quote, becomes the painful mantra for all short sellers. Markets can remain irrational longer than you can remain solvent.
That says it all.
Shorting high-growth, high-valuation stocks is incredibly dangerous because even if you are ultimately right on the intrinsic value, it is simply impossible to predict the most insane multiple the market will be willing to pay for that growth story in the meantime.
So the bottom line is you have to find a flaw that permanently hurts the growth prospects or the earnings power, not just one that proves it's overpriced today.
Exactly. Valuation is the symptom, not the disease.
So if valuation is just the icing on the cake itself must be some kind of structural failure. That takes us right into the definitive short-selling framework, focusing on those specific structural flaws that almost guarantee future disappointment.
Right. And before we dive into the flaws themselves, it's useful to differentiate between types of shorts, just to set the context.
Okay.
We can broadly categorize them to make sure the research aligns with the likely timescale. You have tactical shorts. These are often shorter-term trades, maybe based on anticipating bad news, weak quarterly numbers, or some macroeconomic speculation.
More opportunistic.
Exactly. But our focus today is really on structural shorts. These are the longer-term bets. They're based on identifying endemic business model issues, or maybe irreversible industry decline, or financial shenanigans like accounting fraud that will eventually cause chronic failure.
Yeah.
These take time to play out.
Got it. Structural is the key. Let's start with structural flaw number 1. Unsustainable leverage and, crucially, hidden debt. We saw financial leverage was central to the subprime crisis with the banks, but how does this manifest in non-financial, sort of regular operational companies?
Well, leverage just borrowing money. It works both ways, right?
Yeah.
It accelerates profits when things are going well, makes the returns look great.
Sure.
But it massively magnifies losses when the business slows down or it hits a rough patch.
Yeah.
And that magnification effect can wipe out shareholder equity incredibly quickly. But the most insidious form, the one short sellers really look for, is hidden leverage. Things like off-balance sheet liability.
Hidden leverage, like liabilities that are intentionally structured so they don't look like debt on the main financial statements?
Yeah, precisely. The goal is often to make the balance sheet appear healthier than it really is, and maybe to inflate return metrics like return on equity or return on capital.
How do they hide it?
A classic example is long-term commitments, like signing 10-year rent agreements for thousands of store locations. These are often classified as operating leases rather than capital leases.
And what's the difference in accounting?
An operating lease is treated primarily as an rent expense, which appears above the line on the income statement each year. But critically, the total future obligation doesn't appear as a liability on the balance sheet itself. A capital lease historically did show up as debt. Accounting rules have changed here somewhat, but the principle of looking for hidden obligations remains.
So they are effectively hiding massive, unavoidable future payment obligations from the main debt calculation, making the company look less risky.
That's often the trick, yes. It obscures the true level of indebtedness and financial commitment. Short sellers know this, so they dig into the footnotes of the financial statements. They look for the disclosures about future minimum rental payments.
Okay. Then they calculate the discounted present value of those future rent obligations, effectively capitalizing the lease obligation to reveal the hidden debt load.
Let's use the Office Depot case study from the source material to see the impact of this kind of, well, accounting sleight of hand.
Right. So back in 2010, Office Depot reported its on-balance sheet debt. Based on that, it had a seemingly manageable debt-to-equity, or DE ratio, of 0.85. Looked perfectly fine on the surface.
Less than 1 sounds okay.
Yeah. However, short sellers adjusted for the hidden leverage. First, they added back $1.25 billion in obligations related to an off-balance sheet revolver, a type of credit line.
Okay.
And then, crucially, they added back a massive $2.16 billion, which represented the capitalized value of those long-term operating leases, the rent commitments they found detailed in the footnotes.
So what happened to the debt-to-equity ratio after they added back all that real debt?
It absolutely soared. The true adjusted DE ratio jumped from that benign 0.85 all the way up to 6.
6. That's a huge difference. A massive gap, created almost entirely by hidden off-balance sheet leverage. And a ratio of 6 is very high for a retailer. It put the company dangerously close to potentially breaching their credit covenants, the rules set by their lenders.
Right. So Office Depot was vulnerable not just because it was in a struggling industry, retail facing online pressure,
Right.
but because this hidden debt load meant that even a moderate slip in sales could risk technical insolvency or force a painful restructuring. The structural flaw was the hidden debt magnifying the impact of the industry decline.
Precisely. Moving to structural flaw number 2, the reliance on a single product or maybe a single client. This concentrates all the business risk onto one very narrow, fragile point.
Yeah, that seems intuitively risky.
It is. Companies that derive the vast majority of their revenue from just one key product. Think of a biotech firm with only one successful drug in the market.
Or maybe a supplier selling 80% of its output to one giant customer.
Exactly. They face exponentially higher risk of failure. And the risk isn't just normal business competition. The catalyst that breaks the story can often be regulatory, political, or perhaps most commonly in healthcare reimbursement risk. An insurance company changes its mind.
The Questcor Acthar drug story is a perfect and painful example of how quickly that specific risk can materialize.
It really is. Questcor's drug Acthar was a high-profile, very expensive drug. By 2011, the stock was soaring, absolutely flying, driven by rapid prescription growth, especially for treating multiple sclerosis patients.
So what was the hidden flaw?
The flaw was its incredibly high price tag, combined with its total reliance on continuous, essentially unquestioned insurance coverage for uses beyond its original, much rarer indication.
Okay, so what was the specific failure point? What triggered the collapse?
The catalyst hit suddenly in September 2012. A major insurer, Aetna, published a clinical policy bulletin stating they would severely limit reimbursements for Acthar.
How did they limit it?
They restricted coverage primarily back to its original, much rarer approved use, infantile spasms or West syndrome. They effectively cut off reimbursement for a large part of the profitable multiple sclerosis segment that had been driving the growth.
Ouch. I imagine the market reacted pretty instantly to that single change in policy from one big insurer.
Oh, immediately and violently. The stock plunged nearly 50% on that news alone.
Wow.
Because the market immediately worried, quite rationally, that other insurers would follow Aetna's lead, which they often do.
Yeah.
And this was quickly followed by an SEC investigation into their marketing practices.
So it snowballed.
Exactly. It demonstrates clearly that for a single product company, especially a high-priced one, a seemingly minor regulatory or insurance policy change can act as a massive, potentially fatal catalyst. The short thesis identified the concentration of risk. The insurer's policy change provided the shockwave.
Got it. Finally, structural flaw number 3. Understanding the difference between industry secular decline versus just normal cyclicality.
Yeah.
When do you short an entire industry or a company within it? Is it when it's temporarily down or when it's fundamentally broken?
Yeah, this is critical.
Yeah.
The focus for a structural short must be on secular decline. That means irreversible changes that fundamentally break the business model forever.
Like what? Give us examples.
Think of the internet just destroying traditional newspaper advertising revenues, or the rise of streaming video dismantling physical video rental in distribution businesses like Blockbuster.
Permanent shifts.
Permanent shifts.
Yeah.
And the key realization here, famously observed again by Warren Buffett, is that when a management with a reputation of brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact.
Meaning even a superstar CEO can't save a business if the fundamental economics are permanently broken by secular change. The ship itself is sinking.
Exactly. You can't short sell hope in a turnaround that defies gravity, but you can short sell structural obsolescence. Whereas cyclical pressure is temporary, even if it's really painful in the moment. Think about fluctuating commodity prices or temporary overcapacity in an industry.
So how does cyclicality play into shorting then?
Well, the danger comes when a cyclical downturn gets combined with excessive leverage. That combination can become fatal, even if the industry itself isn't doomed forever.
Tell us about the Pilgrim's Pride example from 2007-2008.
Right. Pilgrim's Pride was a major U.S. chicken producer. They faced extreme cyclical pressure back then. The prices of corn and soybeans, which are key inputs for chicken feed, absolutely skyrocketed.
Okay, so input costs went way up.
Way up, severely hurting their profit margins. Now, this cyclical pressure was then compounded by high financial leverage, mostly stemming from a major acquisition they had recently done.
Ah, the leverage factor again.
Always look for the leverage. And historical analysis showed a clear consumer behavior flaw for the industry. Chicken producers found they couldn't pass on more than about 5% of those higher feed costs to consumers in the form of higher chicken prices.
Why not?
Because shoppers would simply shift to other, relatively cheaper proteins like beef or pork if chicken got too expensive. Demand was elastic at a certain point.
So they were trapped between rapidly rising costs they couldn't control and selling prices they couldn't really raise.
Exactly, which meant their margins were absolutely crushed. And because they were so highly leveraged from the acquisition, that margin pressure quickly translated into big operating losses, putting them at severe risk of breaching their debt covenants with their lenders.
And the outcome?
Pilgrim's Pride eventually filed for bankruptcy protection. It's a perfect example of how a severe cyclical downturn, when paired with high financial leverage in a largely commoditized industry, can quickly become a structural fatal problem, even if people are still eating chicken.
The leverage was the amplifier that made the cycle deadly.
Precisely.
Okay, we've established that the short thesis must target a genuine structural flaw. Now let's look at the results of those flaws manifesting, starting with the infamous value trap, often called a fallen angel. These are stocks that look temptingly cheap on the surface, but are actually toxic underneath.
Yeah, value traps are dangerous because they look inexpensive based on traditional backward-looking metrics, maybe a low price-to-book ratio, PB, or a high free cash flow yield. Seems like a bargain.
Right.
But they suffer from irreparable structural changes, or, critically, hold massive, unacknowledged liabilities that make the reported value completely illusory. The ultimate case study here has to be AIG in 2007, just before the financial crisis hit full force.
Right. AIG, it seemed cheap then, didn't it? Trading at like 1.4 times price to book, which historically for an insurer might suggest it was undervalued. What made it a ticking liability bomb instead?
The book value was essentially fictional. It didn't reflect reality. Why? Because AIG, particularly its AIG Financial Products unit in London, held massive, concentrated exposure to credit default swaps, CDS.
The insurance on mortgage debt.
Exactly. Insurance written on those toxic subprime mortgage bonds. Now, these transactions were often structured to be off-balance sheet and were only disclosed, if at all, deep in the footnotes of their complex financial reports.
Okay, so hidden exposure.
Hidden and massive. And crucially, AIG was relying on something called mark-to-model accounting for valuing this huge CDS portfolio.
Explain mark-to-model again. Why is that inherently riskier than standard mark-to-market accounting?
Okay, so standard accounting generally prefers mark-to-market. That means you value an asset based on what a willing buyer would pay for it today in an active, transparent market. You use observable market prices.
Makes sense. Real prices.
Right. Mark-to-model is what you use when there is no active, transparent market price for the asset, which was increasingly the case for complex CDS linked to subprime debt as the crisis unfolded.
Yeah.
So the company essentially gets to create its own internal mathematical model to estimate the asset's value.
Ah, so they're grading their own homework, basically.
That's a good way to put it. AIG was using highly optimistic internal assumptions about the housing market and default rates to estimate the value of its toxic CDS portfolio. They were essentially saying, our models show these are still worth close to par.
Even as the actual housing market around them was visibly collapsing and related securities were plummeting in value.
Exactly. They were not recognizing the massive mark-to-market losses that everyone else in the market was seeing and reporting. When the credit crunch finally hit, counterparties demanded collateral, regulators stepped in, and AIG was forced to acknowledge the true market value, or lack thereof, of its CDS exposure.
Yeah.
It resulted in losses in the tens, then hundreds of billions of dollars. It completely wiped out AIG's reported book value and required a massive government bailout. It perfectly demonstrated how a stock looking cheap on PB was actually a value trap masking catastrophic, poorly accounted for liabilities.
Wow. Okay, now for the flip side of value traps. Broken growth stories. These are the high-flying companies, often tech or biotech, whose projected growth path turns out to be clearly unsustainable due to competition, market saturation, or shifting market dynamics.
Right. Growth companies are obviously very attractive to investors, but they become highly attractive shorts when clear signs emerge that the core growth drivers or the assumptions about profitability or even the total addressable market size forecasts are fundamentally flawed.
Where did we see this play out historically?
The solar panel makers around 2008 are a perfect historical example of a broken growth story.
Right. Companies like First Solar, FSLR, were trading at absolutely insane valuations back then, weren't they?
Totally insane. FSLR, I think the source mentioned, traded at something like 43 times sales. Not earnings, sales.
Unbelievable.
That valuation was predicated entirely on the idea of limitless global demand for solar panels and sustained high profit margins. But the short thesis identified two clear, predictable catalysts that were about to break that story wide open.
What were they?
First, a massive global capacity glut was emerging. It was driven largely by new, heavily subsidized Chinese competitors entering the market aggressively. This inevitably started to drive down the selling price of solar panels everywhere. Margins were compressing.
Okay, so competition and price pressure. What was the second factor?
Second, and perhaps even more critical, was the impending decline and eventual expiration of key government subsidies, particularly in Germany and the U.S. These subsidies had been artificially inflating the demand for solar panels for years. It wasn't purely organic market demand.
Ah, so the growth was heavily reliant on government support that everyone knew had an expiration date.
Exactly. It was baked into the legislation. So the valuation was built entirely on a temporary structure of subsidized demand and artificially high margins, both of which were visibly about to disappear or significantly shrink.
So the short wasn't just it's expensive, it was the reason it's expensive is about to end.
Precisely. It was a bet on inevitable disappointment. Once the market finally recognized that the fundamental economics of the solar industry were changing dramatically due to the capacity glut and the subsidy withdrawal, those high-flying solar stocks plummeted, some by 30, 50, even 90%. The crazy valuation was merely confirming the level of risk. The structural flaw was the dependency on temporary government support and unsustainable margins.
Makes sense. Finally, let's turn to the accounting checklist. These are the specific financial statement symptoms or patterns that can flag deeper underlying issues. As we stress repeatedly, the accounting issue itself isn't usually the entire short thesis,
Right.
but it is often the smoke that leads you to the fire, the structural flaw.
Absolutely. You have to scrutinize areas where management has discretion, look for divergences, and question classifications. The key is always analyzing the quality of reported earnings versus actual cash flow, and hunting for those hidden liabilities or aggressive assumptions. We can break it down. Number one, revenue recognition. The core question here is the company booking revenue when they ship the product to a distributor or retailer that's called sell-in, or are they waiting until the end customer actually buys it, which is sell-through?
Why does that difference matter so much?
because sell-in accounting can be used to inflate current results. It can lead to channel stuffing, where a company aggressively pushes more product onto its distributors than they can actually sell just to hit quarterly sales targets.
And the sign that.
You'll often see accounts receivable, the money owed to the company by its customers, ballooning much faster than actual sales revenue or cash collected. It means they're booking sales, but not getting paid quickly.
Okay, red flag number 1. What's next?
Number 2, expense classification, particularly around leases, which we touched on with Office Depot.
Right, operating versus capital leases.
Exactly. Remember the purpose. Classifying a lease as operating historically kept the liability off the balance sheet and treated the payment as a simple rent expense on the income statement. Classifying it as capital put the asset and a corresponding debt liability onto the balance sheet. Short sellers dig into the footnotes to see if significant obligations are being hidden off balance sheet, perhaps to artificially inflate metrics like return on capital.
Got it. Number 3.
Number 3, adequate provisioning. This is about whether management is being realistic about assets losing value. Are they avoiding necessary write-downs?
Like what kind of write-downs?
You look for things like excessive or clearly obsolete inventory building up on the balance sheet. The source material mentions Skechers having issues with certain outdated product lines at one point. Or, and this is a massive red flag, often following big questionable acquisitions, inflated goodwill and intangible assets.
From M&A deals that went bad.
Precisely. Think about HP's colossal multi-billion-dollar write-down related to its disastrous acquisition of autonomy. Management teams are often very reluctant to admit they overpaid, so they keep inflated values for goodwill on the books for too long. A large write-down is an admission of failure.
Okay. And the last one.
Number 4, divergence. This is simple but powerful. Look for wide and persistent variations between net income, which is based on accrual accounting,
Right.
and cash flow from operations, which is actual cash coming in and out. If a company consistently reports, say, $100 million in net income, but only generates $10 million in cash flow from operations year after year,
Something's fishy.
something is very likely fishy. It probably means they recorded a massive amount of sales that haven't actually been paid for yet, like that channel stuffing issue.
Okay.
Or maybe they have a huge inventory backlog they haven't sold, or perhaps they're capitalizing expenses inappropriately. The quality of those reported earnings becomes highly suspect. Cash flow is harder to fake.
And the Diamond Foods case study is the classic illustration of how an accounting symptom can expose a much deeper, fundamental business flaw. Right.
Exactly. Diamond Foods stock came under pressure initially when analysts and short sellers noticed the company seemed to be using some, let's call them accounting tricks. Specifically, they were shifting the timing of when they recorded momentum payments owed to walnut growers
Why would they do that?
to artificially inflate their fiscal 2011 earnings and meet Wall Street's expectations. The actual accounting fraud itself was relatively small in dollar terms, but it acted as the crucial catalyst. It prompted the short sellers to dig much deeper.
And what did they find underneath?
They found the core problem. The underlying profitability of Diamond's legacy walnut business was rapidly deteriorating, and they were facing severe pressure on their gross margins across the board. Management was desperately trying to mask this fundamental decay.
So the accounting tricks were a symptom of desperation.
Completely. They even resorted to desperate strategic moves, like the planned, ultimately failed acquisition of the Pringles brand to try and buy growth and distract from the core issues. But it was the initial accounting irregularity that pulled back the curtain and exposed the sheer desperation driven by the underlying business weakness. The accounting smell led straight to the fire.
Okay, we have the framework for finding structural flaws. We have the accounting warning signs. Now we have to address the really agonizing part of short selling, managing the position itself and dealing with the intense investor psychology involved.
You said earlier, shorting is truly a hurdle race, not a patient marathon like long investing.
That's absolutely right, because the market is not a tidy, rational place, especially in the short term. And you constantly have to survive the risk of a short squeeze. This is arguably the single biggest, most immediate risk short sellers face.
Explain what that is exactly. Okay, a heavily shorted stock. That means one where many investors have borrowed shares to sell short, especially if it has a low float, meaning relatively few shares are available for trading, or a high short interest ratio.
Yeah.
Is incredibly vulnerable to volatility. If any piece of unexpectedly positive news hits, that stock could be earnings, could be a new contract, could be an acquisition rumor, anything. Desperate short sellers, especially those who are heavily leveraged, might be forced to cover their positions quickly to limit further losses. Covering means they have to buy back the stock they previously sold short.
And that buying pushes the price up.
Exactly, which forces more shorts to cover, creating this vicious self-reinforcing cycle. It can lead to massive, explosive price surges that have nothing to do with the company's long-term fundamentals.
We saw this kind of drama play out spectacularly with Netflix almost a decade ago, didn't we?
Oh yeah, Netflix was a classic example. It had been heavily shorted for a while due to valuation concerns and the Quipster debacle.
Yeah.
Then, Carl Icahn, the famous activist investor, suddenly announced he had taken a substantial long position buying stock and call options.
Okay, big name, positive news.
Huge name, positive signal. That news immediately triggered a major short squeeze. The stock soared something like 20% overnight, maybe more.
Wow.
When your potential loss on a short is theoretically unlimited, unexpected surges like that, driven purely by market positioning and sentiment, not fundamentals, can be absolutely devastating. It can lead to margin calls from your broker, forcing you to liquidate at the worst possible time.
This inherent terrifying risk is precisely why legends like Warren Buffett and especially Charlie Munger famously approach shorting with such extreme caution, bordering on aversion. Munger has said something like, "They don't like trading agony for money."
That sums it up perfectly. The risk is fundamentally asymmetric, as we said at the start. You are staking significant capital, time, and stress for a maximum possible gain of 100% if the stock goes to absolute zero.
Right.
Yet you're facing the theoretical, if perhaps unlikely, risk of infinite loss if the stock just keeps going up. It requires an iron stomach, and frankly, it's just not worth the mental anguish for many very successful long-term investors.
Yeah. The source material mentioned fund managers like Jean-Marie Avillard, known for his value approach. What was his alternative?
Right. Avillard often preferred simply raising his fund's cash allocation as his primary way to express a bearish opinion on the overall market or specific sectors by holding more cash.
He avoids the direct risks of shorting.
Exactly. He limits his potential downside risk to simply underperforming a rising market, rather than taking on the stress, the borrowing costs, and the unlimited liability potential of an outright short position. It's a more conservative way to be defensive.
So what's the risk mitigation alternative then if you do have high conviction in a company's eventual collapse, but you really want to cap your potential losses? You don't want that unlimited risk.
The most common tactical answer is to utilize put options. Buying a put option is essentially like buying insurance on a stock's decline.
How does that work?
You pay a premium at cost of the option contract, and that premium becomes your absolute maximum possible loss on the trade, no matter how high the underlying stock goes.
So your loss is defined upfront.
Completely defined. Unlike shorting the stock directly, where you need to borrow shares, post initial and maintenance margin, pay interest, and still face that unlimited upside.
Risk buying a put option limits your maximum loss to what you paid for it. But it still offers the potential for potentially multifold returns if the stock drops significantly below the option's strike price before it expires.
So it transforms the risk profile from scary and asymmetric to known and defined.
Exactly. It costs money, the option premium, but it buys you peace of mind against that runaway stock scenario. Now, let's talk about betting against management. We've been focusing mostly on financial data, structural flaws, but sometimes the biggest risk isn't just the balance sheet, it's the person sitting in the CEO chair.
Indeed. This is a more subjective factor, but Zoll suggests it is often statistically unwise to bet heavily against a proven star CEO, especially one who has a demonstrable track record of delivering on enormous, complex, seemingly impossible risks, or maybe just one who commands excessive market hope and belief.
And the prime example that comes to mind today has to be the Elon Musk factor at Tesla.
Absolutely. For years, despite the perpetually high valuation, the constant operational headaches, the production challenges, the missed deadlines, betting against Elon Musk was notoriously dangerous and painful for shorts.
Why specifically?
Because he had built up this spectacular, almost unbelievable track record of delivering on huge, incredibly risky ventures. SpaceX, Tesla itself, maybe even Solar City initially. One short seller panelist quoted in the source material basically argued that simple Bayesian probability, updating your belief based on new evidence, pointed to the very low odds of successfully betting against someone with that kind of repeated delivery record on moonshot projects.
So the idea is that star management can continually capitalize on market hope and deliver just enough unexpected positive surprises to overwhelm even a strong, fundamentally based short thesis.
That's often the case, yes. They keep pulling rabbits out of hats, or at least the market believes they will.
But wait, isn't relying on a CEO's charisma and track record exactly what people like Chanos and Paulson taught us not to do when assessing fundamentals? Isn't that just betting on hope, which is supposed to be the long investor's job, not the short seller's?
It feels like a contradiction, doesn't it? But I think it highlights a subtle difference. It's maybe the difference between betting against outright fraud or irreversible structural decline versus betting against complex execution risk.
Okay.
If the business is structurally flawed due to insurmountable debt or fundamental obsolescence, even a great manager will likely fail eventually, as Buffett says.
Yeah.
But if the short thesis is based primarily on it's too expensive and they can't possibly execute on these ambitious plans,
Yeah.
a truly exceptional star CEO might possess a hidden asset.
Yeah.
The ability to execute on a real option that the short sellers haven't properly valued or anticipated.
Okay, let's define that hidden option concept using the Netflix story again, but this time after its stock crashed badly in 2011 following the Quickster price hike controversy.
Right. So after the stock dropped maybe 70%, the bears were pounding the table, arguing the business model was fundamentally broken, competition was coming, pitched margins would collapse. The short case looked strong.
But what did they miss?
According to some analyses, they missed the inherent latent value of the company's single largest asset, its existing, large, and relatively loyal subscriber base. At the time, maybe 23 million subscribers globally. This base represented a valuable, real option for management.
How does a subscriber base act as an option? What does that mean?
It gives management the strategic flexibility to pivot, to experiment, and to monetize that existing customer base in completely new ways, potentially without even cannibalizing the core subscription business too much.
Like what?
Well, we could look at the Hulu model back then as a comparison. Analysis suggested that if Netflix simply launched a new, cheaper, tiered service that included advertising, even if only a small portion of its subscribers opted for it, it could potentially generate maybe $600 million to $800 million in incremental advertising revenue.
Okay, new revenue stream.
Right. And that incremental net income stream alone, if capitalized by the market, could justify adding over $6 billion in valuation back to the stock. That potential upside from just one strategic pivot using the existing asset, the subscriber base, was potentially large enough to overwhelm the entire bear thesis, which was focused mainly on subscription churn and content costs.
So the star CEO, Reed Hastings in this case, had the credibility and the asset base to unlock that latent value, that hidden option.
Exactly. And shorts who ignored that possibility got burned again as Netflix recovered.
Okay, finally, let's talk strategy for when to actually hold or fold the short position. You find a flaw, you put the trade on, but you can't just blindly stick to your original thesis if the facts on the ground change or the risk profile spikes dramatically, right?
Absolutely not. A short seller must be constantly vigilant, constantly reevaluating, monitoring for unexpected material developments that could either strengthen or, more importantly, invalidate the original thesis or just make the risk too high.
So when do you hold firm, even if the stock temporarily moves against you, goes up?
You hold, or maybe even add, when the fundamental structural shift driving your thesis remains clearly intact, despite some temporary positive news or a short-term bounce in the stock. The example used was staying short on F5 Networks, a networking equipment company.
What happened there?
Even though their product sales accelerated for a quarter or two, surprising the market positively, the core structural thesis hadn't changed. That thesis was that large cloud data centers like Google and Amazon and Microsoft were increasingly moving towards building their own custom commoditized networking hardware internally.
Right, cutting out the middleman.
And bypassing F5's expensive proprietary off-the-shelf devices. So even with a temporary sales bump, that underlying secular trend, the move away from F5's model by its biggest potential customers, was still firmly in play. The positive quarter was seen as just a cyclical blip within a longer-term decline. So you hold.
Okay, makes sense. And conversely, when is it time to fold, to cut your losses and run, even if you still believe your original thesis is technically correct in the long run?
You fold when unexpected material developments significantly increase the risk profile of the short position, making it untenable, regardless of your long-term view. The example given was folding a short position in Western Union after the stock had already risen about 30% against the short seller.
Even though Western Union's core money transfer business was, and arguably still is, facing long-term structural decline from digital competitors.
Right. Even though the long-term structural decline thesis was likely still valid, other things changed the immediate risk equation. Management took aggressive actions like announcing large share buybacks, which supports the stock price. They raised short-term financial guidance, creating positive news flow.
Okay.
And critically, the short interest ratio on the stock had doubled, indicating the trade was becoming very crowded. All these factors combined made the risk of a painful short squeeze simply unacceptable. Prudent risk management dictates an exit when the environment becomes that volatile and crowded against you. Even if you think the company is ultimately doomed, you have to live to fight another day.
Preserve capital.
Exactly. Survival is paramount in short selling. Hashtag tag tag outro drug.
What a detailed and frankly nerve-wracking discipline short selling is. So to recap the core framework, successful short selling is really not about just picking an expensive stock. It requires painstakingly identifying clear, verifiable structural issues, be it unsustainable hidden leverage, maybe a dangerous single product dependency, or an irreversible secular industry decline.
Yeah.
And then, crucially, finding specific negative catalysts like a regulatory investigation, a major insurance policy change, a key client loss, or even accounting red flags that will force the market to recognize the problem and lead to disappointment. Valuation in this very high-stakes game, it seems, is merely the confirmation that the potential payoff might be worth all the agony and risk involved.
That sums it up well. At the end of the day, to really profit consistently from a short, the company's business model must fundamentally fail to produce the sales and earnings growth that the market currently expects and is priced in. It's a calculated, forensic bet on future disappointment, not just a comment on current overvaluation.
Which brings us perfectly to our final provocative thought for you, the listener, to mull over. Given the absolutely critical role that hidden and off-balance sheet liabilities played in the spectacular collapse of companies like AIG and the near-death experience of Office Depot, where massive commitments like CDS exposure or those long-term operating leases were effectively obscured from plain view, we have to ask ourselves, where are the modern equivalents of these obscured liabilities potentially hiding today?
That's the question. Today, perhaps those hidden commitments or risks might lie buried in the complex structures of SPACs, especially around redemptions. Or maybe in complex contingent earnouts tied to some of these massive tech acquisitions we've seen. Or perhaps hidden within deferred revenue models that complicate the true picture of sustainable cash flow for subscription businesses.
So the question for you is, what commitments, what contingent liabilities might be lurking right now, obscured within the complex financial statements of today's largest, most acquisitive, fastest-growing companies? What key warning signs, based on the framework we discussed, might you be missing in your own portfolio analysis, even if you're purely a long investor?
The devil, as they say, is always hiding when the numbers get complex and the disclosures get murky. Something to think about.
Definitely something to think about. We'll see you next time on The Deep Dive.